What's going on, you all? Guess who it is? Yeah, it's the CoWaCo, the company water cooler. We're back again for another class, and we're about to get it in. Remember, like, subscribe, comment, and share. We're not financial advisors. This is for education purposes only. But we about to learn. All right. All right. So first off, we're going to talk about REITs, real estate. Make sure I get the right initials. Investment trust. Chris, what you got to say?
Yes, sir. Yes, sir. First and foremost, thank you all for joining us, ladies and gentlemen. We appreciate you. I am Chris. That right there is Leroy. Thank you for watching the company water cooler. So we're going to talk about REITs very briefly here as an extension of our dividend talks over the past couple of weeks. So I know, this is going to be the sort of the hook for our dividend mini series in the class. So a real estate investment trust is exactly what it sounds like. It's the trust that invests in real estate. These are public stocks, obviously stock market class. These are public stocks that deal with and involve real estate. You got three major types. So you got equity real estate. This is most REITs, right? R.E.I.T, Tango, right? This is most REITs. So they own and they manage real estate, right? Income producing real estate. So not just land that doesn't yield anything or agricultural. We're talking apartment complexes. We're talking condominiums. We're talking homes, mortgages, right? This is what an equity REIT is. So the money that they make is generated through the rent that they bring in, right? Then you have mortgage REITs, obviously same thing, but it's mortgages, right? So it's the money that they make from that is made from the interest on the mortgage loan and then the cost of funding those loans. So the interest that you pay on your mortgage for the house, they're making that as well. This is the mortgage REIT. So the equity REIT is going to be rental properties. The mortgage REIT is going to be homes. This is going to be, this is how they're going to secure their funding on the principal that was loaned to you, the full amount. So anytime you think about a loan, when you ask for $5,000, let's say over a 2-year period, and at the end of that 2-year period, you do your calculations and you're paying back $5,700, right? That's $700 interest on top of the $5,000 you borrowed, $350 a year, right? So whatever that percentage is added up. So these REITs are making money off the mortgage interest, Then you have hybrids that work with both. So you have hybrid REITs that do mortgage and they do equity. So they do rental. A few pros about REITs. It's very liquid, so it's easy to pull money. It's easy to get money out, easy to put money back in. It's diversified across all markets, so you're gonna have mortgages not in just one part of town or one part of the state or one part of the country, right? You're gonna have mortgages, you're gonna have rentals and leases all over the country, right? The stability of cash flow through dividends, right? Because a REIT, and I'll read here in a little bit because I have a list in front of me. I'll read here in a little bit a couple of the qualifications of a REIT. A couple cons: it's low growth, so don't expect for a REIT that you invested in to jump 30%, right, in a year, to jump 50%. Don't expect it to act like a tech stock, right? The income is not fixed, obviously, because it fluctuates, but it is stable. It is pretty stable income. And then, of course, if the housing market is doing well if the housing market is good for buyers, it's a buyer's market, because the demand is low, but the supply is high, and sellers can't fill homes, right? They can't get people to buy homes. They can't get people to rent from them because they already have places elsewhere, or they're already secure where they are and have been for some time, and it's a buyer's market. Your dividend that you get from that REIT is subject to that. Right now, we live in it's a seller's market now. So owners of properties now, I mean, you know, and we've all seen the stories. They're getting, you know, sometimes 100% above asking price, right? In many cases, 50, 60%. You list a house for $300,000 and somebody will come in and offer $450,000 cash, right? And it's like, you know, it's crazy, but it's a seller's market right now. So the demand is high, but the supply is low. So new apartments coming up, new apartment complexes, new condominiums, they're starting off 15, 16, 1700 because they're going to fill up very, very quickly. And people, you know, to sort of match that, people have the money to spend on, you know, rents now, $1,800, $2,000 a month to stay in a closet. People got that kind of money. The dividend yield is really good because, like I said, they have to offer an extremely high percentage of their money in dividends. But the risk of using, there's a debt risk associated with real estate investment trusts because they have to give out 90% of their money. And I'll just go ahead to my list right here. So real estate investment trust, how does a company qualify? So I'll give you a couple qualifications. REITs must pay out at least 90% of the taxable income to shareholders as dividends each year. So 90% of the taxable income they have to pay to you. And many of them will pay out more than 100%, right? Which, you know, how do you pay out more than 100%? That's debt, right? You have to, the income that you make from a REIT is taxable. So it's a non-qualified income. So you want to avoid any taxes with receiving income from dividends from REITs. It's just what, you know, they do have like a 12 or 15% reduction that you can get if you pay yourself out under an LLC, and then that'll take your percentage down to 20. Otherwise, you'll be taxed at whatever the current tax rate is, which I think is 35%. So that's another con of it, right? You have to pay back a third. You will be taxed on that. More than 50% of its shareholders are held by 5 or fewer people during the first half of the taxable year. So you have no more than 50% of its shares held by 5 or fewer people. So you have to have investors. People have to put, you know what I mean? Like, you have to have people. They must invest at least 75% of total assets in real estate assets or cash. So they can't hoard the money. The money has to go back out into the real estate market. And I'll just read another one. A board of directors or trustees must manage them. So I can't say I'm going to start a REIT and manage that REIT. I have to have a board of trustees and a board of directors. But that list is a long list amongst plenty that qualify you for a REIT. So again, you have equity REITs, that's rentals, that's leases. You have mortgage REITs, that's mortgages. You have hybrid REITs, that's both leases and mortgages. Underneath, and there's a link that I've asked Leroy to put in the description. That is a Motley 4 link describing 35 million different type of REITs under these 3 categories. You have some companies that specialize in commercial property. You have some companies that specialize in construction property, like as specific as you can get, there's a REIT for it. It fits under, these are the three major categories, but they have REITs specific for so many other real estate properties. It's ridiculous, right? So that link is going to be in the description. Look there to see, okay, well, this is this kind of REIT, this is this kind of REIT, that's that kind of REIT, because you can still be an office REIT, but then be an equity REIT because you're leasing out your office space, right? So you're making money from the monthly income you're getting from your tenants in your office. Still an equity REIT, but it's an office REIT as well. So Leroy's going to put that description in the above the comment section. Check that out. But real estate investment trusts are, it's a stable stream of income. You do have some monthly dividend giving real estate investment trusts. Realty income, ticker symbol O, is a very popular one. It's very good. Yep. Good for both. Stag. Yep, Stag is one. Sierra Tango Alpha Gamma. And then you have NLY. That's another low cost one that'll get you a quarterly dividend. So all of really what you use REITs for is to generate income for yourself. Keep in mind, again, it is taxable income, so you're not going to avoid paying taxes on it, but it's a stable income machine for you to grow your portfolio, put that money back in those REITs, and then explore other options with some leftover money that you have from those real estate investment trusts.
All right, that's what's up. All right, you all. Now, we about to talk about how the holidays affect your portfolio. What's going on, Chris?
Yeah. So the holidays they will be here faster than you know. And it's very, very important to understand how the fourth quarter affects your portfolio. So people start buying stuff, I'd say October, really like the end of September, after Labor Day, honestly, right? And that's going to send Amazon shares up. That's going to send Target shares up, Walmart. That's going to send Apple shares. All of these companies are going to do really well because, most companies have to do fourth quarter of the year is make back money that they lost throughout the year, or enough to put them in the black for the rest of the year, so they have something to brag about to their shareholders. So you'll see a lot of sales going on, right? If a laptop is originally $219.99, but a sale has it at $179.99, that's not really a sale, right? Because it didn't cost $179.99 to make that computer. It cost probably $50. So the sale could be $51.99, and whoever's selling it is going to make a profit. But I'm charging for labor, building costs, all of those factors are cost in there. So let's say it costs $50 to make a really nice laptop. After shipping costs, after labor costs, after overhead from the facilities, after maintenance of the facilities, after all of that, your total cost comes up to $70 to make that laptop from the ground through conception to the actualization to getting it to someone's hand. $71 is still a profit, right? So what you're going to start to see is a lot of sales on things, right? Oh, well, this is 2 for $5. This is 2 for $6. This is 2 for $10. A sale is a marketing tactic. If I pay $5 for something and I usually sell it at $20, and I've made enough money from selling it at 20, I'll give you a sale and list it at 15. I'm still making 3 times the amount of money, right? I'm never gonna sell it for $5 because now I'm breaking even. And obviously I'm not gonna sell it for less than $5 because then I will be losing money. So the holidays, watch out for these sales that they have and understand that a lot of the companies, good companies, obviously, because the only thing we talk about up here, that you invest in, watch how it moves up, watch which ones move up, which ones move down, right? Retail, people are going to be outside, people are going to be shopping. I suspect it's going to go up. Technology, every mom and dad is buying computers and tablets, smartphones, and all different kind of doodads and electronics for their kids over the holiday. So expect for electronic companies to go up. You could expect for cybersecurity companies to go up because a lot of people will be shopping online. A lot of people obviously want their identity protected. These companies are going to have specials offered to people over the holidays. So, and I'm not a trader, but I know that in the trading world, a lot of selling, there's a high volume of selling shares, and then you have to look at quadruple witching too. But a lot of selling of shares is a high volume trade right around Thanksgiving. And then a couple of days after Cyber Monday, I believe. And so just before the market closes on the holidays, it's going to be a lot of trading in the market. Again, not a trader, but I do know that. So pay attention to that. But look for these retail giants, Target, Walmart, to make money. Look for these technology giants, Apple, Google, Microsoft, to make money. Look for the software giants, CrowdStrike, to make money, right? Look for what people are buying, right? I would say you could, if you're interested, I love cars, right? If you're interested in cars, I would say don't make a play on vehicles until tax time. Because what do most people spend their tax money on? New tags, new titles, right? So if you want to make a play on Ford and GM, wait until February, wait until March, right? Because you see a lot of new tags around during that time. Spring break, it's hot, the ladies got the shorts on, they in the bikinis. I want to pull up in the nice whip, I want to impress, so I'm gonna go spend a couple $1,000. And I'm not the only one doing that, right? So it's gonna be me and a couple other brothers doing that as well, and we'll see how it goes for each one of us. So if you want to make a car play, I would say wait until the spring, wait until just after the first quarter, and then you can start making plays on cars. But the holidays, Thanksgiving, Christmas, you want to look at tech stocks, you want to look at retail giants.
That's what's up. Now remember, you all, look, if y'all shopping at these stores, you need to be investing in them. They making money off of you. We said this before, they making money off of you. You need to make money off of them. You spend your money there? Man, come on now. You need to go ahead and just cock them up. Again, you don't need a lot of money to invest in them. 5, 10, 20, a week, 2 weeks. And guess what? When you actually investing in them, right? You see your money growing. And then whenever these times come up, when people be running to the stores and actually purchasing, it's like, oh, ooh-wee.
Right.
I'm making some money too.
Your pockets will thank you. Seriously, your pockets will thank you. I mean, I think now, Leroy, I think people are getting smarter with holiday shopping, and a lot of them are doing their online shopping now, right? June, July, August, to avoid that rush. But it's what's going to happen every year. 70%, 70.00% of the American economy is based off of what you buy and based off of what is sold. 7 out of every $10 So if we stop buying and selling things tomorrow, this country will crumble. Luckily, that's not going to happen. But 7 out of $10 of the United States of America GDP is based off of what you buy and what is sold to you. So every year from from the end of September through January, you are going to see a high volume. It doesn't matter what's going on in the world. People are going to spend money. When you get an influx of anything and you are not aware of how to use that properly, it will dissipate just as quickly as you got it, right? If you checked your mailbox today and you got a $3,000 check, the first thing you're thinking is not, oh, well, what REITs will I invest in? The first thing you're thinking is, okay, I need to pay off this loan, that loan, that. You're thinking about how to get out of debt, which is great. That's fantastic, right? But let's not put ourselves in that position in the first place. Let's take 1,000 of that and put that towards investments. And then let us pay the minimums on our debt from the remaining amount of money. Take the income that we're getting from our W-2 or the income that we're getting from our 1099 or the income that we're getting from our dealings in society. Let us take that money and let us put that towards the debt that we have while we're still growing assets over here on that side. So let us use that, but pay attention to the holidays. Now is a good time to get in. During the holidays is a good time. It's always a good time to get into the market. But right now, especially in the summer, just before things are starting to heat up, Walmart, Target, Amazon, Apple, good to go.
All right, you all. We about to do the favorites of the week. Yeah. So, as Chris was talking here, now, so my first one that I'm actually going to say is called CoStar as in Romeo, Cone Star Group. All right. So this particular company, right? What they do is, because he was talking about REITs, they actually own most of the websites that you actually do your real estate business on. Now, this particular
look, Leroy, spell that again for me.
It's spelled C-O and then S-T-A-R as in Romeo. And then group.
C-O-S-T. Okay, C-O-S-T-A-R.
Yep.
Okay.
Group. And their ticker symbol is C-S-G as in George, P as in Paul. So this particular stock,
because that's the one that had a split last year.
There you go.
Yeah.
That's the one.
Last year.
Yep. That stock was $800 something before it split. So with the split, it came down to $80 something. Now, since how the market is going now, it's lower than $80 something right now. It's like $70 something or something like that. But just imagine as the economy eventually, it's gonna kind of take off, even though things are shaky right now, where like a lot of stocks are actually down, so that's getting hit also too. So stock market eventually is going to get back up. Once you actually purchase it, you can be able to actually remember this is holding, holding on to it, taking advantage with holding on to that particular stock of business.
Yeah.
But you do want to, you know, check out the finances, chart, news, you know, add all that in, you know, before holders, before, you know, making a decision on it. But just check it out. All right. My next one. Ha 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 ha. I never mentioned this one before. Five Below. Five Below the store. So he just was talking about the holidays, right? So the Five Below stock, you will be shocked on how much that particular stock actually is. So when you look at this video, I want you to go and check that stock out. Okay. Check out the finances, the chart, all that. You will be shocked. Holders, people be sleeping on Five Below.
Yeah, what's that ticker?
Hold on, let me look real quick what their ticker symbol is for Five Below.
And while you're doing that, Five Below, Big Lots, Dollar General, all of these places where people will go as a secondary are they're gonna make a killer. And you know, these are typically retailers aimed at low income consumers, right? So you've got $20 or $30, but you need to get a whole lot more than what $20 or $30 worth of toys will usually buy. So you go to Five Below, you go to Big Lots, you go to Dollar General. But what's the ticker they were?
It's a five, F-I-V-E.
Okay.
Yeah, so that's the ticker of that one. And then my last one.
You good. A lot of people do sleep on that though. You right.
Yeah. And then my last one is Target.
Yeah.
So that's my last one.
Yeah,
I like
because
Target.
It's Target. Yeah, you're right. Yeah. I mean, listen, Target is a fantastic company. And I'm gonna say Target too. That's my first one. So we're gonna share that one because Target is, and I really think what does it for Target is their service.
That's what it is, yeah.
The service that they provide people is top notch. So I definitely think that's what puts them over the top. On the flip side of that, I'm gonna say Walmart too. I'm gonna say Target and Walmart. Listen, Walmart is a great investment because Walmart is everywhere. Walmart is so everywhere, right? Walmart is, I mean, when you have $5 to spend and it's like, man, I need to get cereal and milk, you got to go to Walmart. You can't go to Target and get cereal and milk for $5. You can't do that. You got to go to Walmart. So Walmart got you. You're going to have to look because ain't nothing in place in Walmart, but they got you on, you know what I mean? You go in there, you take that $5, you get some cereal, you get some almond milk. So I'm going to say Walmart, and then, you know, the dividend, of course, but what Walmart is working on in terms of competing with Amazon for market share of online deliveries, I think they're gonna have a nice setup. They're not gonna take obviously the lion's share of the market. Amazon already has that, and it's not changing anytime soon. But they're gonna shave some percentage. They're gonna shave some points off of Walmart's hold on the market. I mean, Amazon's hold on the market. Apple is my third company because it's Apple. They got people in their pocket and they know how to keep them there. Every institution that you respect has Apple in the portfolio, so you should have it in yours. And the software that they develop, I mean, 30% just to host, like for them to host, it's crazy. Like they're making money hand over fist. And then Amazon. Amazon is, they're going to take delivery services to a new height. So there is a concern with UPS. You know, that's my favorite logistics company, but there's a concern with UPS about heat strokes happening with the drivers, right? Because UPS requires so much of their drivers. And then there's a lot of Amazon workers that are also leaving. Don't fret, because they will automate their services and drone deliveries will happen, and Amazon won't need as many human beings to deliver packages, and that will trickle down to UPS, and that will trickle over to Walmart, and sooner or later, none of these logistics companies will need human beings to deliver anymore because they've got 24/7 drones, they've got autonomous vehicles dropping packages off at your mailbox, so on and so forth. So that's not tomorrow, that's not 5 years, right? 10 years, 15 though? I mean, I would definitely, if you work at Amazon right now, you're in a good position. I will tell you that right now, but I would say, look to go on the software development side, look to move up in the company in the office setting, on the technology development coding side, because the prescribed route, the prescribed area, look for that in 15 to 20 years to look totally different. So Target, Walmart, Apple, and Amazon.
I also want to mention too, when he said Walmart, right? And we was talking about real estate earlier. Okay. Now, Walmart, when they're actually placing their stores, they're thinking about real estate. Whenever they're actually placing their stores. So keep that in mind too. So I definitely want you to keep that in mind. It is not just trying to, you know, even though they have products that they actually sell with the groceries and everything, they think about real estate. How are we going to actually come in, buy this spot, the hot spot too now, place it. Oh, we can get the real estate too.
Yeah.
So.
Oh yeah. Yeah.
Just want to mention
and look where every Walmart is situated. Every Walmart is situated either inside of a shopping center or next to one. But Walmart owns that real estate. Every Walmart sits on an acre of land that Walmart owns. So even if Walmart says we're not here anymore, they're going to lease that land off, and people will know that as the place that once was Walmart, and then whatever replaces Walmart will still be making money. Same thing with McDonald's. McDonald's is a real estate company that sells hamburgers, right? So don't you look at the expenses, look at what the business is, because the name of the game is ownership. It's cool, great value is cool, right? It's cheap, you go in, you get what you need, whatever. But the actual value of Walmart lies in the land that it sits on top of. Because if there's a Walmart over there, there's typically a Dollar Tree or Big Lots or Dollar General or something close, a Burger King or McDonald's or a Taco Bell, because everybody's going to be drawn to Walmart. But oh wait, I'm hungry. I gotta go get a burger. Oh, I gotta go get a chorizo. I gotta go get a burrito. I gotta go. Oh, okay. Let me go get some jerk chicken. I gotta. Oh man, I gotta go get some fufu, some plantain. Well, these people are thinkers, so they know this. So if I'm going to situate myself in a very busy intersection of whatever city it is, multiple spots in the city, and I'm going to pull money in by offering my products at cheaper prices than the competition, and you'll still go spend your money with them, but you're coming to me first.
That's that foot traffic. All right, you all. That's it. The CoWaCo company water cooler. What? Thank you all for watching. Like, subscribe, comment, and share.
And we'll see y'all next week.